starting with paper assets. A paper asset is like a stock. On paper, it says you have ownership in a company. When the average person says my investments are diversified, they generally mean something like I have stocks in blue chip companies, I have some emerging market stocks, and maybe I own some AI stocks. So I'm diversified. But the problem with that is all of our investments are in paper assets. All of our money is in the stock market, and we've seen the stock market go up and the stock market go down. And even though you own different types of stocks, when you see a stock market crash, many times the broad stock market gets hurt. And this is where you want to understand that that's just one type of asset class. The stock market is just one type of asset class, but it is an important asset class. And here's the mistake that so many people make. They say, I want to come in and buy here and sell here. This is a rough depiction of the stock market where we know markets go up and markets go down. So we want to buy here and sell here, but that's not what actually happens. Instead, what many people end up doing is they end up buying at the top and then they end up selling down here because they panic and they sell. And the reason why is because there's a lot of emotion around the stock market, and because it's paper, it's very easy to buy and sell. You can buy and sell your stocks on your phone or your computer, and here's what ends up happening with the emotion. When markets are going up, people get excited. People talk about how much money they're making. And then you have the media come in and they talk about how people are getting rich buying stocks. Uber drivers are making more money from the stock market than they are actually working as an Uber driver. And then you start to get more people excited, and then you start to hear the Reddit communities and other social media communities talk about if you just buy these stocks, you're going to be able to get rich. Then what do you think happens? A lot of people who have never invested their money before or who are newer investors get excited, and then they start to come in and buy at this area right here. Then you start to see this little bit of a dip, and people start to get scared because now markets start to go down. Oh no, did I buy at the peak? Am I going to lose money? Because now you're investing your hard-earned money and you never want to see it in the red. You never want to see it go down. And then the media comes in and they say, oh no, was this the peak? Is the market going to crash? Are we on the way down? Are we going to see a recession? Are we going to see a market crash? And what happens? Because it's paper, because it's liquid, it's very easy for people to come in and sell. And then as people start to sell, markets start to go down, people panic, and then they sell at a loss. So instead of buying low and selling high, people actually end up buying high and selling low. And this is where, if you're just getting started as an investor, one of the simplest things that you can do is follow a strategy like A, B, B. Always be buying. You buy here, 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 here. You're buying when the markets are going up and down. You can create a simple system where you're buying every week, every 2 weeks, every month, and now you don't touch it. You don't touch it if you're in a recession. You don't touch it if you're in a market boom, and you let the markets do their thing. In fact, do you know how many recessions we have seen over the last century? 16. And so when you have these recessions, markets go down. And when markets go down, most people panic, but they also create great buying opportunities for those that are financially savvy and understand that if you just ABB, always be buying, have an automatic system, just keep buying. You buy every week, every 2 weeks, every month. Well, now you don't got to worry about it, and that has been a proven way to win. But then the next question is, what do you actually buy as a paper asset? Which stocks do you buy? Should you buy Tesla? Should you buy Amazon? Should you buy Apple? What should you buy? And here's the reality. If I tell you which stocks you should buy, chances are you might lose because you don't know when to sell, you don't know when to buy. But if you just want to win, not to mention that you might have a different goal than me because I like investing for cash flow, meaning dividends. And this is where one of the simplest ways that you can start is not try to find the next Tesla, not try to find the next Amazon, but instead just invest in the economy. Let me show you. Now, this is where I got to give you a disclaimer because I'm not a financial advisor. I'm just a random guy on YouTube, and investing has risks. You're never guaranteed to make money when you invest. In fact, you will lose money at some point, so make sure you always do your own due diligence and never blindly trust a random guy on YouTube. But let's talk about a few ETFs, meaning funds that you can invest in to give you exposure to the broad economy. One example, VTI. This is an ETF that gives you exposure to the total stock market. This is created by an institution called Vanguard. If you buy one share of this on your stock brokerage, you're essentially buying the total stock market, a piece of all the companies that make up our stock market in the United States economy. ETF example number 2, SPY. This is an ETF that gives you exposure to the S&P 500. This is a group of the 500 largest companies in the stock market. So if one of these companies starts to not do good, they start to maybe go on the verge of bankruptcy, well, they get kicked out of the S&P 500 and they get kicked out of the fund and replaced with another company. This is an ETF that gives you exposure to that S&P 500. DIA is an ETF that gives you exposure to the Dow Jones. The Dow Jones is one of the oldest indexes out there, meaning groups of stocks out there, which is kind of like a little sample of the United States economy. Example 4, QQQ. This gives you exposure to the NASDAQ. The NASDAQ is a group of the 100 largest non-financial companies. So many of these are actually tech companies. So if you're investing in QQQ, you're investing in those 100 large non-financial companies, many of which are tech. And just for fun, I'm throwing in one more, VYM. I am personally invested in this one. This is an ETF that gives you exposure to dividend-paying companies, more specifically, high-yield dividend-paying companies. Again, this is created by Vanguard, so if you like cash flow, this is one that you can consider. But there are many other types of ETFs. This is just a way to get you started on your research. You can start to see how we're thinking differently than the majority of people, because when most people think about investing, all they think about is the stock market, but that's just the beginning. And this is where you want to invest in multiple different types of asset classes so you can have real diversification, because if the stock market were to crash, well, now you have different types of assets to protect you as well. Now, if you want to be a smarter investor, this is why my team at Briefs Media publishes a free newsletter called Market Briefs. It's published 6 times a week, and it breaks down what's happening in the financial markets. We cover things like the stock market and the real estate market and the crypto market and the global economy and our own economy into a fun and witty and easy to read newsletter. That way you can be a smarter investor. It's a completely free newsletter. We have hundreds of thousands of investors that are reading and loving Market Briefs every morning, and it's completely free. So if you haven't joined Market Briefs and you'd like to join, I got the link for you down in the description below. Now let's talk about hard assets. An example of a hard asset would be investing in something like real estate, because when you invest in real estate, you can see, feel, and touch the bricks. You can see, feel, and touch the property. When you invest in a stock of Amazon, you don't actually own any physical thing. You buy a piece of paper that says you own some of the Amazon company, but if you walked into the Amazon factory, they wouldn't know who you are. When you invest in a rental property, well, now you are the one that's in control. It is a hard asset, and you see, feel, and touch the land that you own. Now notice that I said real estate investment rental property. When I talk about investing in a hard asset, I'm not talking about you buying the home that you live in. That home that you live in, I consider a liability. I consider an expense, not an investment. I know this goes against most traditional financial advice that you get, but for me, the house that I live in is an expense. It's not putting money in my pocket. Sure, maybe it goes up in value, but then I have to actually sell the house to realize that money, or I have to take on more debt. But that's not actual money, that's debt. So when we talk about real estate investments for the purpose of this video, I'm talking about going out and buying a rental property, because when you have a rental property, here's how it works. Maybe you go out and you find this house for sale for, we'll call it $200,000. Now the goal is you're not going to buy this house to live in yourself. You want to rent this house to somebody else. So you find a nice family who wants to live in this house, and because you built this amazing house for them, they are excited to live in this property, and maybe if you do it properly, they will pay you, let's call it $2,100 a month to live in your property. This is the money that's going to you as the landlord, as the investor for owning this property. Now, the first thing you're going to say, I already know, is, Jaspreet, where in the world are you going to find a property for $200,000 that you can rent out for $2,100 a month? Well, if you're living in Miami, if you're living in California, if you're living in New York, yeah, it's not going to be possible. But there are many states and many cities around the country where you can find these types of deals. In fact, my office is in downtown Detroit. In Southeast Michigan, which is a beautiful area, by the way, you can find these types of deals all day and night long. So you find a property for $200,000 that you're now going to rent out for $2,100 a month. It's a nice property. This family is happy that they get to live in your property because you're giving them the value of a home. They pay you rent, and now you got to pay for the expenses. What are these expenses? Well, you got to pay property taxes. You got to pay for the property insurance. You got to pay for the maintenance, because when the toilet breaks, you got to pay for it now. Then you got to pay for the management, because I don't want you to be the one that's getting the phone calls when the toilet breaks. I don't want you to be the one that gets the calls when something's wrong with the plumbing. I want your property manager to deal with all the headache. I want you to be the investor and just make sure that you're getting paid. And then you got to pay for any vacancy costs as well, because sometimes these people are going to move out and they're going to find a different house to live in for themselves, and you're not going to be getting rent. And so you want to make sure you have the cash to cover that time as well. So now let's run through some numbers. $2,100 a month in rent times 12 months a year is $25,200 a year in gross income. Now you got to subtract your expenses. That's property taxes, insurance, maintenance, management fees, and your vacancy costs. So let's assume that that costs you around $11,000 a year to maintain this property. And I'm going to assume for the purposes of this video that you brought this property cash without a debt, because we're going to just keep this very simple for the purpose of this example. That means your profit at the end of the year after paying for all of your expenses is about $14,200 a year. But now let's do a little bit more math to see if this is actually a good investment or a bad investment for you. You're making $14,200 a year. You put in $200,000. So if you take $14,200 and you divide this by $200,000, what this tells you is you're making about 7.1% a year in cash in return on your investment. You put in $200,000 of your own cash, you're making $14,200 a year, which means you're getting a 7.1% cash on cash return on your money. Is that good? Is that bad? This is going to depend on you, where you're investing, and what types of returns you're looking for. For me, this is a good return. I'm looking for a minimum of a 7% cash on cash return on my money. I want to invest my money in an area which I believe is growing, where I believe rental values are going to rise. I don't really care about property appreciation. I don't like trying to guess that maybe this property is going to be worth $300,000 in 3 years. That's not the game that I'm playing. When I invest in real estate, this is what I'm looking for. This is what I'm looking for. I want to see how much money do I have to invest today and how much cash flow am I going to get each year for my investment. That's the game that I'm playing as a real estate investor. Now you got to decide what's right for you, because if you're investing in New York or Miami or Los Angeles, you're not going to see the same 7 or 8% returns. Generally, in today's market, it's going to be a whole lot lower. And you got to find what's right for you and what types of investments you're going to be looking for. But this is a hard investment because now you own the property, you own the bricks, you own the land, you own the windows. It's something you can see, feel, and touch, and it's something you can operate as well. Now you might say, well, Jaspreet, I don't got $200,000. I'm not saying you have to start with $200,000. There's many different ways that you can get started. If you don't want to go out and buy this whole property yourself, obviously you can use debt. Obviously you can go out and raise money from other investors. Maybe you have rich family members. Maybe you have some rich friends. You can raise money from them if they don't have the time, but they have the money, and you got the time, but no money. Now you are a good match for each other. Or you can look for other deals to invest your cash into as well. If you go to any real estate investor conference in your area, they happen all throughout the country. You can look for people that are looking for money. And there's always people looking for money. There's always developers. There's always investors. There are always people that are looking for funds to go out and build or manage the next deal. Well, you can give them some money and then you get some ownership in the project. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.